Hi everyone, Lukasz Kalwak here from the Franklin Templeton Institute. Lots to unpack this week, so let's get right to it. We'll break down what's been moving the markets and what it all means for your portfolio. Last time we discussed emerging risks in the technology space, and just 2 days later, volatility returned. Market turbulence picked up across several asset classes, catching many investors off guard. Precious metals such as gold and silver experienced double-digit drawdowns. Cryptocurrencies were sharply repriced. Software stocks declined nearly 20% in just 20 days. A magnitude of correction previously seen around the COVID lows or during sharp bear market rallies in past recessions. These moves are uncomfortable, but they are not unprecedented during periods of rapid leadership rotation. Technology stocks were particularly vulnerable due to elevated valuations and heavy positioning after years of outperformance. As interest rate expectations shifted and capital rotated toward value and cyclical segments, long-duration growth assets faced accelerated multiple compression. The chart highlights all historical instances when the software index fell 20% within a 20-day window. In most cases, the broader market required additional time to digest the new flow of information and fully stabilize before a durable recovery could take hold. Despite the recent volatility, the broader market is showing resilience. If you look at the chart, you will see that excluding technology, all major US indices have reached new all-time highs this year. In fact, the S&P 500 equal weight and value indices have been leading the way. Last week, something interesting happened. The correlation between the traditional S&P 500, which is heavily influenced by large companies, and the equal weight S&P 500, where every company counts the same, this correlation fell close to zero. So, in simple terms, even though both indices hold the same stocks, they are moving differently. That's a sign that leadership is shifting away from mega cap tech stocks and toward the average stock. There is more evidence of this rotation. The S&P 500 advanced decline line, which measures how many stocks are rising versus falling, has reached a new all-time high this week. That tells us the rally is not being driven by just a few large cap names. A growing number of stocks are participating, which is generally a healthy sign for the market. The US economy remains in a Goldilocks phase. Growth is solid, inflation is stable, policy conditions are supportive, and corporate earnings are healthy, very healthy. These fundamentals are positive for stocks. However, valuations and where we are in the market cycle still matter. Our analysis shows that in years when economic and earnings growth are particularly strong, S&P 500 returns tend to be more moderate. As shown in the chart, we are currently in the upper right quadrant, which has historically been associated with annual gains in the 5 to 9% range. This suggests that index level returns in 2026 may be positive but modest. At the same time, we expect meaningful differences beneath the surface. Some stocks and sectors may perform much better than others. This type of environment tends to favor active management, exposure to less favored stocks and sectors, and thoughtful international diversification. We remain constructive on both US and global equities over the long term. The global rotational bull market appears intact, supported by solid fundamentals and broader market participation. Midterm election years have historically brought higher volatility. We believe periods of market weakness during such years can create opportunities to gradually add risk exposure to portfolios. Trade well, cheers!